Good morning and welcome to the Fall Brookings panel. This is our third conference of 2020 and following our special conference in June, it's the second focusing on the effects of COVID-19 and the economy. This is a global webinar, so all of the presentations and comments are on the record. In each of the sessions, the authors will present for 15 minutes, followed by a discussant with 12 minutes to present, and then we'll have an open discussion. And I'll repeat these instructions when we get to the open discussion, but to be prepared, if you're in the Zoom session, you'll be able to raise your hand so that we can call on you. And if you're in the webinar, you can use the Q&A and the chat function in order to ask a question that can come through the moderators. Let's begin with our first paper, which is Business Credit Programs in the Pandemic Era. And the presentation will be given by Adi Sudaram.
Great, thanks very much for putting us on the program. It is great to be with you all virtually. So this is joint work with Sam Hansen, Jeremy Stein, and Eric Zwick. And the motivation for the paper is the unprecedented amount of government support for non-financial businesses across the world that we've seen in the last few months in response to the COVID-19 pandemic. This kind of support for non-financial businesses is pretty unusual. In the typical recession, we would expand social insurance programs for households. We may support the financial sector to maintain the flow of credit, but we don't typically actually directly support non-financial businesses. So what we're going to try to do in this paper is provide a conceptual framework for thinking about why we may want to intervene and directly support businesses in this recession, what's different about this recession, and then try to shed some light on kind of the right way to design business credit programs. For concreteness, we're going to focus on two US programs, the Main Street Lending Program, which lends directly to firms, and the corporate credit facilities, which buy corporate bonds. These are both joint ventures between the Federal Reserve and the Treasury Department. And I should just say that at the outset that as the fiscal authority, Treasury is really in the driver's seat here with regard to the design of these programs. So the kind of main overarching point of the paper is that in the global financial crisis, we used multiple equilibrium kind of lender of last resort logic as the central kind of conceptual framework. And we don't think that's the right way to think about the COVID crisis. So in a financial crisis, self-fulfilling prophecies are very important. I run on my bank because I think other depositors will run on the bank too. And that logic means that government announcements of support can be incredibly powerful. If the government announcement that it will backstop a bank is credible, my incentive to run disappears, as does all of the other depositors' incentives. And we can shift to the good no-run equilibrium without the government actually doing anything much beyond the announcement. And so that's how people tend to think about the financial crisis, in part because in the US, our investments in banks actually made money. People interpret that as saying that there really was no fundamental problem, it was just a run. We think the COVID recession is likely to be quite different. We're facing a large loss of economic output, some of which is likely to be permanent. And these economic losses are likely to be mostly determined by the path of the pandemic, not by kind of feedback between the financial markets and economic fundamentals. And so there's just less scope for a kind of multiple equilibrium logic. That doesn't mean that there's no reason for government intervention today. We're going to highlight two distinguishing features of the COVID recession that we think motivate support for firms, but crucially, unlike the multiple equilibrium logic that we used in the last crisis, we think that rationales for intervention in this crisis really suggest that it's important that the government be willing to take credit risk, that it's willing to take some risk of losing money on the investments it makes in firms. And then we'll close by arguing that markets today, which are quite buoyant, seem to be overestimating the government's appetite for this type of credit risk taking. Okay. So we're going to make these points in two models. The first model is about highlights rationales for intervention and has 3 periods. So in the first period, we get some initial bad news, say that a pandemic is spreading and we'll have to do social distancing, which is going to adversely affect firm cash flows. There's aggregate uncertainty in this first period, which is resolved in the second period, and it can resolve favorably or unfavorably. Think of favorably as meaning, we get good news that a vaccine is possible in the short term. Unfavorably is that it's not, that we're going to have to wait a long time for a vaccine. Okay, and then there's a new steady state is the last period. So that's the timing. We're going to have a continuum of firms that differ in their exposure to the shock, and each firm has the option to exit at each of these time periods. To motivate government intervention, we're going to think about 2 separate frictions. One is a credit market friction at time 1 that will limit the amount that firms can borrow at time 1. The second is that there may be aggregate demand externalities at time 2. Specifically, what we're going to assume is that each individual firm's cash flow at time 2 is increasing in the total number of firms that are operating at time 2. And you can think of that as a reduced form for demand spillovers at the zero lower bound, or labor market congestion, things like that. Okay. So with this setup in the private market equilibrium, we should first note that even in the private market equilibrium, some firms that have negative cash flows at time 1 are going to continue to choose to continue to operate. And that's just because there's private option value to delaying the exit decision to see whether the aggregate uncertainty resolves favorably or not. So some firms that are taking losses in the first period are going to survive in the private market equilibrium. With these other frictions, the planner is going to want to keep even more firms alive than the private market. Why is that? So let's think about credit market frictions. There are going to be some firms at time 1 that have negative cash flows, but are expected in the long run to have positive cash flows. And in a frictionless world, they would borrow against that expected value of positive future cash flows in order to remain operating at time 1. With credit market frictions, they just can't borrow enough. And so this highlights, we think, one difference between 2020 and prior recessions is we think there's just many more such firms today. So, in a typical recession, the fact that a firm has 0 revenue is a pretty good signal that the firm is not going to be viable in the long run. But in the current pandemic, that's less the case. The fact that our daycare has 0 revenue today doesn't really tell us much about its long-run viability. The second reason the planner keeps more firms alive at time 1 is that there's quote-unquote social option value to doing so over and above the private option value of delaying exit. And the reason is that if the uncertainty resolves favorably at time 2, more firms are going to survive and there will be larger positive spillovers. So if the planner chooses to keep more firms alive at time 1, it's essentially preserving for itself an option to have very large spillovers at time 2. And so that's what we think is a second distinguishing feature of the current recession, is that there's just much, much more aggregate uncertainty today than there is in a typical recession. Okay. And so in addition to generating these rationales, the model also gives us some kind of specific prescriptions for program design, and I'm going to compare those for concreteness to the actual design of the Main Street program. So a first implication of the model is that aid needs to be widely available in the sense that the government should be lending to firms that the private market will not lend to. In contrast, the Main Street program actually involves the government co-investing with private banks. Banks make the loans and then they retain a part of those loans, which means that ultimately the only loans that get made are those that are profitable or attractive to private lenders. Second, the model suggests that the government should be willing to lose money on investments in some firms. The planner in our model faces the same kind of frictions the private market does. It's just maximizing a different objective function. And so it's willing to lose money in order to kind of generate higher social welfare. In contrast, the Main Street program is quite restricted. It's only going to lend to relatively low risk firms, and therefore it's kind of not targeted towards the right marginal firms. And a third implication from the model is that it's quite important to stage financing. We need to be able to change course as uncertainty about the pandemic resolves. That means lending a little bit today and then lending more if we get good news and less if we get bad news about the path of the pandemic. In contrast, in the Main Street program, firms can take out relatively big loans now, and that's kind of it. So there's not really much capacity to respond as conditions evolve. And just putting these last 2 points together, we think it's quite important that the right way to control risk in these programs is staging, not careful underwriting. We should retain the ability to cut back on support if we get bad public health news. We shouldn't really be trying to make fine-grained distinctions about which firms are viable and which firms aren't at this point. Finally, the model suggests that loan terms should be soft in the sense of giving borrowers flexibility in when they pay back the money as opposed to hard. But in fact, the Main Street program's lending terms are relatively hard. The loans are senior, they're relatively short maturity, there's not much flexibility. I will note that in some respects, the Paycheck Protection Program, which we'll hear about more later today, is closer to model design in some respects, and maybe we could talk about that in the Q&A. Now, despite this divergence between kind of what our model says is the right way to design these programs and their actual design, the programs have had a huge effect on financial markets. So this graph shows the evolution of credit spreads on risky high yield corporate bonds this year. Spreads rose dramatically in March as the pandemic really got going and have been coming down ever since. And as you can see from the graph, there's some suggestive evidence that the recovery in spreads has been driven in part by government announcements of support. So you can see that announcements for the corporate credit facilities and Main Street in March and April coincided with significant declines in spreads, as did a May 29th speech by Fed Chairman Jay Powell, where he said, you know, we've crossed a lot of red lines, but we're committing to do whatever we can for as long as it takes. Now, if you look at the longer history of credit spreads, so now I'm going back to 1996, you might be worried that markets have overreacted to these announcements. So credit spreads, as you can see, normally rise in recessions, which is quite natural because corporate defaults rise in recessions. But you can see here that spreads are actually at their average level over the last 25 years, not at elevated recession levels. So our second model in the paper is about thinking about the possibility that markets have reacted so strongly, in part because they're overestimating how willing the government is to support the bond market. So again, a simple 3-period model, and we're going to think about a risky corporate bond. In the last period, the third period, that bond's risky cash flow is going to be realized. At time 2, there's fundamental news. So there's news about that ultimate risky cash flow. There's also non-fundamental news, which you can think of as capturing things like noise trader risk or leverage-induced fire sales. Now, that means that at time 1, the bond's price will be the expected cash flow at time 3 minus a risk premium that compensates investors for these different risks. The risk premium both includes a risk premium for fundamental risk as well as a risk premium for non-fundamental risk. Okay, so what happens if the government now comes along and introduces what we call a purchase reaction function? So depending on exactly the realizations of the shocks at time 2, the government is going to buy more or less bonds.
Adi, you have about 2 minutes left.
Perfect. Now at time 1, if investors understand the government purchase reaction function, they'll charge a lower risk premium because they understand that the government's going to be offsetting some negative shocks. Right? What we think might be going on, though, is that investors are misperceiving the purchase reaction function. So they think that the government is going to purchase more aggressively than it actually is. That means that prices are even higher at time one than they would be if the investors correctly understood the government's reaction function. And now there's kind of the risk of a big price crash, because if we get negative fundamental news at time two, prices will fall both directly because of that news, and indirectly because investors will realize that the government is less aggressive than they were hoping for. So is this really what's going on? It's hard to say so definitively. In the paper, we provide two bits of evidence. The first is that the corporate credit facilities are largely, though not entirely, prevented from buying the riskiest, lowest rated bonds. But as I showed you in the previous graph, spreads on those bonds have come in significantly. We also think the second kind of piece of evidence is that it's unlikely that the government will offset true fundamental cash flow risk. So it's unlikely that the government is going to buy defaulted bonds to prevent investors from having to absorb those losses. And yet, prices have risen so much for bonds that are quite likely to default. And so we have a conservative estimate in the paper that suggests that the risk premium on bonds, just comparing current prices to historical default rates, the risk premiums on low-rated bonds are actually negative. Investors should expect to take losses because they're not charging enough for the defaults that are potentially coming down the pipeline. There is an alternative hypothesis, which is effectively multiple equilibrium for non-financials. Essentially, the market rally has now allowed firms to raise enough cash by issuing stocks and bonds that they can survive, so there won't be any defaults. This is certainly a possibility. I think what we think is that feedback loop is probably not strong enough to take the large majority of defaults off the table. So just to conclude, government interventions in financial markets are often motivated by multiple equilibrium logic. The classic example of this is Mario Draghi's whatever it takes speech. We think that this ability to make an announcement and then follow it up with little action and yet shift the equilibrium is unlikely to apply in the current environment. There are real economic losses that need to be borne. There are nonetheless compelling rationales for government intervention. We do think the government should be intervening. It's just that the government needs to be willing to take credit risk for these interventions to be fully effective. So thanks very much.
Thanks, Adi. The discussant is Nellie Lang.
Give me access. Okay, thank you. I'm trying to get a full screen here. Okay, so thank you very much for asking me to discuss this paper. It's a terrific paper. It's very constructive, provides many useful insights. I think, the overarching message that Adi mentioned is the 2000 pandemic crisis is not a financial crisis, and government needs to embrace a greater risk of credit loss. So the paper, as Adi went through, offers two different models for government support. And uses them to draw to highlight the Main Street facility and the corporate credit facility. So my discussion today, I'm going to, while these programs are joint ventures between the Fed and the Treasury, the Fed has limitations. And in particular, the Fed has limitations about credit risk. What can a lender of last resort do when there is credit risk? And just 2 points to just sort of give the picture of why they have issues. Generally, first, borrowers must be solvent. And two, the security for emergency loans needs to be sufficient to protect taxpayers from losses. So you can kind of see up front when there's the prospect of high credit losses in government business credit programs, how the Fed engages will affect some of the decisions. In the end, I agree with the paper. I'm going to argue that the Fed actions have bought time and reduced the potential for a doom loop, but they really can't be a substitute for fiscal responses. Through that lens, Main Street is an odd fit. I think I may find it a little odder than this paper does. And then the corporate credit program is manageable, but the Fed really should clarify its objectives, its reaction function. So let me start with Main Street. Adi presented the paper very clearly, so I don't need to go through this, but there are two frictions that lead to differences between the private market and the planner's outcomes. So the predictions for the government is it should invest in riskier firms. It should expect to lose money on some investments. And one of the nice innovations of the model is it predicts staged financing, which I think is a new element to it. And that is basically to support firms initially to get to the next stage, which is especially important when aggregate macro uncertainty is high. And that is an element that is not currently in the Main Street program. And what we know about the Main Street program now is it was very hard to set up. They announced it in March. It didn't come out till a couple months later, and it's been revised multiple times. And there's been very little take up so far. Maybe $1.5 billion of loans have been made. Now, the Fed, because of its constraints, needs banks to help make these loans when you have private market information and you want to ensure that the firms getting the loans are solvent. And then it wants the banks to keep a share of the loan, in this case, in this particular program, 5%. So that's going to, the other constraint is that you want to design the program so that the borrowers will borrow, but many borrowers may not want more debt. So there are some hard constraints on designing this program. It's not a trivial thing to do. The staged finance is nice because it can encourage borrowers. If borrowers are really uncertain about what the path of the pandemic is and the macro economy, they don't want to take on a lot more debt. Staged financing gives them some choices. They can take a little. If things go badly, they might be able to take more. It also helps the lenders, but it may not help the lenders sufficiently. Because of the share, the lenders may not be willing to make any riskier loans than they might otherwise. They're just going to make the same loans since they have to keep some on the books. And to illustrate this, I'm just going to highlight two things. Banks, this is the net lending standards for commercial banks from the Senior Loan Officer Opinion Survey. And that blue line at the end there, that blue sharp rise is the July observation. So banks definitely are tightening standards. They don't want to make loans that are exposed to the same risks they already have. It's about as high as it was in 2000 in the global financial crisis. But at that point, banks couldn't make the loans. I think right now the banks don't want to make the loans. I agree with the model that under softer standards, more equity-like features to the loans that they propose could help and be within the financial constraints. And I think staged financing could help as well. But I think it may actually need more fees to the banks to encourage them to make some loans, basically to offset the risk of the share they have to hold. Probably better, a more fundamental change, in my view, than the marginal changes would be for Congress to recognize this is really a fiscal program. Perhaps one could do loans with conditional forgiveness if macro conditions deteriorate. This has some features common with stage financing, but I still think there's also some political risk for banks. And if the Fed is involved and needs to have banks retain a share, there will be some issues with getting this program effective. I want to turn to the next program, I think, which is probably less well understood. At least I agree with the authors that it's definitely may not be understood by market participants. So in contrast to the Main Street program, the corporate bond purchase programs have dramatically eased financial conditions, even before, and this all, much of it occurred before they actually bought any bonds. The model in the paper suggests, though, that this is still not a credit risk-free program, especially if investors misperceive the Fed's reaction function. And if you, the language around the introduction of the secondary market credits facility is that it is to support credit to employers by providing liquidity to the market. And so it suggests its aim is to fix dysfunction in the markets, but that will also boost asset prices. So I think there is clearly room for ambiguity about what the Fed's reaction function is. Just to highlight again what the alternatives are, under a traditional lender of last resort reaction function, the Fed would offset technical factors that push prices away from fundamentals, but it wouldn't interfere with the adjustment of prices to new fundamentals. The paper argues this still could require the Fed to take on some credit risk in bad states of the world at T = 2. Alternatively, the Fed could be viewed as pegging the risky bond price at T = 2. And in that case, the Fed would definitely need to purchase risky bonds very aggressively in response to negative news at T = 2. So the paper offers some evidence that investors believe the Fed is focused on prices, basically the kind of the pegging, sort of more of a monetary policy function than the traditional lender of last resort. And they show that spreads are compressed relative to the past 25 years, and that they're well below recession levels. And I agree with that, but I want to offer some evidence to support a traditional lender of last resort motive, suggesting that these transition costs down the road could be, in fact, quite big. So the left panel is just the corporate bond spreads. You can see March 23rd event and bond prices fell. What the right panel is just the ratio of the investment grade to the high yield corporate. And it just says that the investment grade spreads rose a whole lot more than the high yield spreads during this episode, suggesting there were some real technical factors going on in the investment grade market. This is a different illustration, and it's from a paper by Haddad, Marrera, and Muir, which shows for investment grade, it shows a scatter plot of the CDS spread for a particular bond against the bond spread for that bond. And the blue dots are the investment grade bonds. And it shows for a given CDS price change, a CDS change, the bond spread went way up. So they're way above the 45-degree line. The orange marks are high yield bonds, which tend to follow the 45-degree line more. So this is suggesting that the spreads for investment grade bonds are reflecting much more than fundamentals. And there's some additional evidence that suggests bid-ask spreads on investment grade bonds went way up, even above those for transacting in a high yield bond. So again, the investment grade bond market showed some serious signs of illiquidity. And just one more chart.
We have about a minute left, Nellie.
Okay, great. Perfect. One more chart, which is that the outflows to investment grade bond mutual funds were unusually large. That the outflows from high yield bond funds were large, but that hasn't been unusual. The investment grade was very. So the implication of this, so I think there is strong evidence there were technical problems in the investment grade corporate bond market, which supports the need for the secondary credit facility. I think, though, markets may be misperceiving the reaction function, as the paper says. The implication of that is prices may be too high, and they will fall more if fundamentals deteriorate. First, because fundamentals deteriorate, and then second, investors have to adjust their perceptions of this reaction function. And so, but I do think there's clearly a role the Fed could clarify their objective function to reduce expected losses if fundamentals deteriorate. And so just to summarize, the Main Street stage financing could help a lot, but I do think that there would need to be higher fees for banks to participate. Again, because the Fed requires banks to participate in the program, there needs to be something. But if pushed, I would say it actually needs a much more fundamental change. And the corporate credit, the paper highlights the potential cost, which is just a very useful lens to look at this problem through. But I do think the Fed could reduce this misperception to help ensure that this program continues to be a successful one. Okay, thank you again. Thank you again for inviting me to comment on this paper.
Okay, thank you, Nellie. That was really helpful, and it really sets the stage for the discussion now from the audience. So attendees here, you can put your hands up to ask questions of the authors or of Nellie. We have a few questions in the chat, so let me start with those. There's a few questions that are in the direction of designing the Main Street program, which is a theme of the paper. And let me group two of them together here. One is thinking about the long run impact of the Main Street program, and in particular debt overhang, which was emphasis of a paper that we saw in June. And so how do you think about the design of the program if you think about the long run costs? And in particular, there's a second question that says, if you're encouraging taking on credit risk, are loans really the right instrument, or would you think about grants or some other program designed to try to address those issues? So let me turn it back to the authors after we take a few more questions. It gives you a little time to think about them too, and maybe group together some of the answers. So from among the attendees, when I call on you, you won't have video, but you should have audio. So let me start with Gabe Chodorow-Reich, and then we'll go to Steve Davis.
Thanks a lot, and I enjoyed the presentation and the discussion a lot. It seems very useful. I wanted to suggest or sort of ask about a role for regulatory forbearance in this, and in particular, what I have in mind is that most mid-sized and large firms have credit lines, and these credit lines mostly have maturities well into 2022 or beyond, and firms have not exhausted them. And so this seems like potentially a useful way to complement new liquidity programs. But many firms are going to be violating covenants because sales are just way down. And so it seems rather important how banks are going to react to those, and that there maybe is a role for regulators in encouraging the treatment of existing pre-committed liquidity as a complement to new programs.
Hey, Steve Davis. Steve, you are unmuted. You should be able to go ahead. Okay, Steve, we can't hear you. I'm going to go ahead and go to Wendy Edelberg, who has her hand up, and we'll try you back in case your audio improves. Wendy, go ahead.
And I'll offer to Steve that just before, when Jan was saying that, I got a pop-up saying that I had to click unmute. So I wonder if Steve didn't see the pop-up to click unmute.
No, sorry. Can you hear me now?
Yeah, go ahead, Steve. All yours.
Sorry. So I've got a question about the political economy of staged financing for firms that the paper sets forth. So it seems to me the political logic for support often runs as follows. Some company or sector and their employees were hurt through no fault of their own, and therefore they need and deserve government support. This is a political argument, not an economic one. But that logic argues for more support to adversely hit sectors and firms if and when the pandemic worsens. And so it strikes me that as just a matter of political economy, it's unlikely that the government will pull back its financing support in the way the paper's policy recommendation envisions. And I would just like to get the authors thinking about that and whether we should think about those political economy concerns in the design of policy.
Okay, now let's go to Wendy. Thanks, Wendy.
So the CARES Act put up substantial money to fund the Main Street lending program, and appreciating that, of course, the Fed's requirements is, or at least the way I understand the Fed's requirements is that the Fed can't lose money for taxpayers in expectation. The way I understood that this was working out in real time is that the Fed interpreted things that they should use that pot of money to leverage up the Main Street lending program so that still it would not lose money for the taxpayer in expectation. I'm wondering why they didn't instead say we're going to leverage it up less and use that pot of money to absorb losses in expectation. Would they have been allowed to make that choice?
Okay, thanks, Wendy. Next, we have 3 questions, which will probably use up most of our remaining time. Shebnam Kalimlioscan, Michael Kellett, which might be Mike Kiley, and Don Cohn.
Yes, can you hear me?
Yes, go ahead.
Okay, so just very quickly, I would like to draw a distinction between large firms and SMEs. So especially, smaller SMEs who are not in the corporate bond market. And if we are about losing money, do you think subsidizing these firms directly through grants, not through loans, would be the way to go? And since you did talk about clawing back some of it, just doing it through the tax system, would you think that would be appropriate? Thank you.
Thanks. Now, Mike Kiley.
Hey, Jan, thanks. Yeah, it is me. A very interesting paper, and I really enjoyed it. It focuses very much on the macroeconomic aspects of emergency government credit support, and in particular, the importance of assuming greater credit risk. I wonder if the authors have views on certain microeconomic aspects and whether or not those are particularly critical in program design and may affect sort of overall efficacy and take-up. I think I would ask about at least 3. So first, the primary market corporate credit facilities and the Main Street lending program have a set of restrictions on capital distributions, compensation, and other activities of borrowers. Such restrictions, obviously make a great deal of sense from the taxpayer's perspective and in the public interest. However, is there a risk that the incentives of firm insiders may fail to take into account of, for example, the role of aggregate demand externalities in a way that significantly lowers the efficacy of these kinds of programs, and what sort of features might be incorporated to alleviate those challenges? Second, any government credit program involves a long-run relationship between the non-financial borrowers and the government as a lender. The Main Street program overcomes this challenge by relying on private lenders, but private lenders may view a partnership with the government, as substantially risky, at least from a political sense, or supervisory sense. And I wonder, whether or not this is a major challenge, in program design and how that might be addressed. And, third, or perhaps relatedly, the paper very much focuses on originating loans and the need to be willing to originate riskier loans. But borrowers and lenders may be especially concerned about the sort of back end. What happens when a borrower is under distress? What is that relationship going to look like? And is the government going to be acting in a economically efficient manner according to certain social interests or political interests? Might such issues, both the political but also the administrative complexity, point to issues with program design, and for example, a greater role for grants relative to loans or even equity participations.
And we'll take the last question from Don Cohn and then back to the authors. Don?
Thank you, Jan. Great paper, interesting discussion. I think this responds partly to Wendy. It's the Treasury that really needs to clarify what its appetite for risk is. And the Fed, I agree with Nellie, the Fed could be clearer about its objectives here, but I think in the end, it's the Treasury that needs to say that it's willing to put money at risk. A second point, it's not clear to me that the compression of spreads is a consequence of misperception. It could well be, I don't deny that, but it also might be a consequence of optimism about vaccines and that the better outcome is not that far away. I don't know how one differentiates that. If the authors have any idea, that would be interesting. And the third point is, how do you figure out who to lend to? So some firms won't, even in a good outcome, some firms won't be viable because the economy will have shifted. Some sectors will never get back to where they were before. So it's hard to figure out who's going to be viable, even in the good outcome state of the world. Now, the Fed and other, I know the Bank of England has done this too, have gone in part by saying if you were investment grade going into the pandemic, even if you're a fallen angel, we'll lend to you. So they're using the investment grade going into, and I think partly this partnering with the banks is trying to get the private sector to help figure this out. But it's not the case that that there are a lot of firms who won't be viable even in a good outcome. And I'm not sure, I'd be interested in your thoughts about how to deal with that issue. Thank you.
Great, thanks. We'll turn back to the authors now. You have at most 5 minutes to respond. Sorry, it was a very good discussion, but we know you can be focused in your replies.
And maybe I'll just take a second. First, thanks to Nellie, and thanks for a terrific discussion, and thanks for the questions. Let me just take one piece of this, which is, I think there's quite a bit of ambiguity about exactly where the constraints lie and exactly what the Fed's authorities are. I think we all agree that at a minimum, the Fed has to be secured to their satisfaction so that they think that they're not really going to lose money. Now, that can be done, as I think as Wendy observed, just by having a big enough equity contribution to the special purpose vehicle from Treasury. So given the size of the CARES allotment, basically, that shouldn't be a constraint if Treasury is willing to put up enough. A second thing, I think there's a little ambiguity, but maybe we should stipulate, is whether the securities have to be debt. As somebody else pointed out, I think maybe it was also Wendy, I forget, but like debt causes a lot of problems with debt overhang, with then worrying about workouts, who's going to do the workout, all that kind of stuff. It would be easier if these weren't debt securities. We basically have argued for something that looks more like preferred. Preferred is sort of nice because it doesn't have the kind of hardness of debt, and it's not equity, so the government's not in kind of owning a voting stake in firms. I'm not sure. There's a little bit of legal ambiguity about whether the special purpose vehicle can own preferred, but you can surely do your best to approximate that within the letter of the law by making it extremely junior debt with deferrable interest payments, and essentially doing everything you can to soften it and to approximate that. And of course, they haven't done that. I think, as Don pointed out, this is the Treasury's insistence. They've hardened the debt, senior position, collateral. All that is going to make the workout tougher because the banks are going to be well secured and be inclined to kind of pull the plug. So there's that point. The one thing where I'm not sure I agree with Nellie, or at least I'm not sure, is that there's any constraint on the Fed that, given that these are debt securities, that they have to have also been underwritten by the banks. And it's quite clear in what's happened so far that the banks have been a bottleneck. So I think, we might argue that we'd be better off not having the banks as underwriters. And even if Nellie, we require that in some way, putting them pari passu, putting them equal with one another is really just totally inimical to the idea of the program, because we want to be able to do things. The whole point is to do things that the private sector won't do. So one little trick you could do here, and this might be helpful for alignment, is, if there's whatever 3% interest coming in, lop off the top 1% and say the banks get it if the firm survives for 5 years, something like that. So the banks have some incentive to underwrite, but they have better economics in a sense than the Fed. So you want to at least kind of deal with the fact that we want to do more than just making loans that are available in the private market. I think there's scope for doing it. Obviously, agree with you that congressional action would be helpful, but I think a little bit more optimistic than maybe you are about the scope for doing, sort of clever stuff. If the Treasury Department has to be willing, I think of them as kind of the key binding constraint.
Agree.
Right. Thanks very much. Terrific discussion, paper presentation, and the Q&A from the audience. So we're going to flip over to the next paper now, which is epidemiological and economic effects of the lockdown. The presentation will be given by Alex Arnon. We'll just take a minute to switch over the panel and give Alex a minute to share his slides.
Right. So as I just all right. Are the slides up pretty soon?
Yep, good to go.
They are. You're all set.
Okay, so thank you so much for having us here. And in this paper, basically, we are taking a look at the first 3 months of the pandemic, so March through May of this year. And you may recall it was a pretty crazy time. And so to start us off here, in these plots, each thin blue line is the US county and the thick black line is the national average. On the left, we have the contact rate, which is how likely is a person to be in close physical proximity to another person other than the people that they live with. So in the middle 2 weeks of March, the contact rate fell more than 80% nationwide, just a complete transformation of American society within 10 or 20 days. And contacts collapsed pretty much everywhere at roughly the same time, although we start to see some divergence thereafter in the rate of recovery. On the right, we show a measure of employment. This is the number of people working in a county on a given day. So employment fell at an unprecedented 20% in the space of just a few weeks. And although the declines were really historic pretty much everywhere, note that there's quite a bit of variation in the extent of the decline across the country. And I'll talk more about where these measures come from in a little bit. State and local governments responded to the pandemic with a whole array of non-pharmaceutical interventions. In this paper, we're focusing on 3 major NPIs that were specifically aimed at combating the pandemic by reducing contact rates. So those are school closures, which were typically enacted earliest, stay-at-home or shelter-in-place orders, and then non-essential business closures, by which we mean a universal, all non-essential businesses must close order, so not just any business restriction. And by the beginning of April, basically the entire US population was covered by one or more of these NPIs. They were issued largely by state governments, but also often by county, municipal, or school districts. So our main goal in this paper is to sort of evaluate the relationship between the collapse shown on the first slide and the policy response that we showed on the second slide. And to preview our results, we're going to find that NPIs explain only about 7% of that dramatic decline in the contact rate we saw, as averaging over March, April, and May. And they explain a somewhat larger 15% of the fall in employment. If we translate that into a number of jobs, that's a reduction of about 3 million, a little bit less than 3 million in employment. Now, despite these relatively small effects on the contact rate, we estimate that without NPIs, COVID deaths at the end of May would have been higher by 33,000, or almost a third higher. And then drawing on these results, so with the benefit of hindsight, we argue that policymakers could have achieved the same or better health outcomes with much better economic outcomes if they had deployed these 3 NPIs differently. So to summarize how we're going to get there, we start from a pretty standard model of infectious disease, a SEIR or SEER model, and we're going to expand it in a few ways that are critical for both the simultaneous epidemiological economic analysis we want to do and for thinking about policy. In order to estimate and run this model, we're going to need high frequency measures of contact rates and employment at the county level. These do not exist in general, so we pull together information from a whole bunch of different sources and combine it all to construct the measures that we need. And then once we have these measures, we are going to estimate key model parameters like the response to NPIs in a diff and diff framework that conveniently falls right out of the model. So I'm not going to spend too much time on the model here. You can, there's some appendix slides or check out the paper. Just going to focus on the main component of the model that we are expanding. So in the SEER framework, disease transmission depends on the contact rate. So again, that's being physically close to other people, and on the infection rate, which is how likely an infectious person is to actually transmit the virus given a contact with a susceptible person. Normally in the SEER modeling, both of these factors are just taken as external. There are a couple of big problems with this though. So first, it assumes that behavior is independent of the severity of the epidemic, which does not seem consistent with what we've seen. And second, if you want to think about NPIs in the model, you just sort of need to jam them in from the outside. So what we're going to do is make the contact rate depend explicitly on both how bad is the epidemic where you live and what NPIs are in effect where you live. So to be a little more specific, we make contact rates and employment depend on 3 components of behavior. The first is a response to perceived infection risk where you live. So if the epidemic is better or worse and people become less or more worried about getting infected, they can adjust their contact behavior accordingly. The second component is a response to NPIs. And the third is a precautionary response, which we allow to vary based on the demographic and economic characteristics of a state or county. And this precautionary component really is nationwide common trends that are not related either to local epidemic or to the 3 NPIs. Given our empirical approach, the precautionary term is going to end up picking up some stuff that we might not think of as just people being cautious, like if people change their behavior because of CDC guidance, that'll get picked up as a precautionary. Okay, the first data issue that we face trying to actually use this model is we need historical estimates of the dynamics of COVID-19 and in particular of the transmission rate. The problem is we don't actually know how many people were infected at any given point in time. We only know how many people tested positive, so confirmed cases, and we know how many deaths were attributed to COVID. So our first step here is going to be to estimate the case confirmation rate, and that's the share of the actual true infections that show up as confirmed cases. We do this partly based on test data and partly based on deaths data combined with estimates of the fatality rate. And then, so once we have the true number of infections, we borrow some methods from empirical epidemiology, which along with a state level calibration procedure, we estimate the COVID reproduction number, and from that, the COVID transmission rate. Okay, for the contact rate and employment, I mentioned before that there are not direct measures for these things at the frequency and geographic detail that we require. So what we do is pull together from data from a whole bunch of different sources. And this includes some direct measures for the things that we care about, like the extent to which people are congregating in common places, or how many people were working for a particular set of businesses on a given day. But these direct measures are narrow in scope, they're not representative. And then we have a bunch of indirect measures. stuff like how much time are people spending at home, Google searches for the forms you need to fill out when you hire somebody. So we are going to collect all these proxies, and rather than try and sort through them and work with them each individually, we combine a set of proxies for the contact rate and a separate set of proxies for employment. We take the first principal component of each of those sets, and that gives us a time series of common variation across all of the different indicators that we use. This also has the nice feature that it allows the relevance of different indicators to vary geographically. Some measures, some of our employment proxies might be more useful for tracking employment in some counties and less useful in others. So for the contact rate, we don't actually have really any way to assess the resulting measure since there is no independent data. But for employment, we can compare our index with the monthly frequency official estimates from BLS. So on the left here, we aggregate up everything from the county level to total US employment. On the right, we show the monthly change at the county level in 2020. And so, we are reasonably satisfied that our measure does a good job of tracking the official estimates. Okay, so getting to our results, our first main finding is that most of the fall in both contact rates and employment was voluntary. So this is either the precautionary response or infection fear response, but NPIs played a pretty small role. So here, this illustrates that we disaggregate the total change in contact rate and employment relative to the beginning of March, and these are in log terms. And so we disaggregate these into the three components of behavior. And you can see that especially early on in the pandemic, the precautionary response completely dominates. NPIs had almost no effect really until the last week of March. And for both contacts and employment, the infection risk response explains about a fifth, but again, the precautionary response dominates. And so I had mentioned earlier that the precautionary response can vary based on population and economic characteristics. And so I'll just highlight here a couple of the most significant dimensions of that variation. So here we plot the precautionary change in the contact rate broken out by the Republican candidate's vote share in the 2016 presidential election. So these are quartiles of county level vote share here. And we see that the initial precautionary response was pretty much the same everywhere, the very sharp, rapid decline in the middle of March. But by the end of that month, we start to see some significant divergence along partisanship, and that only grows over time. By the end of May, the precautionary response was basically over in the most Republican-leaning counties, but it was still holding contact rates down by around 50% in the least Republican-leaning. And I'll note here that if you do the same thing by education, age, density, or other correlates of partisanship that might also be driving differential responses, you don't see nearly as large or consistent a pattern. So it does strongly suggest that politics are playing some independent role here. On the employment side, here we show the precautionary response of employment broken out by the share of county employment that is in leisure and food services. So at the lowest point in mid-April, there is a difference of around 5 percentage points between the most and least concentrated in these industries. So this is a huge factor in driving that variation in the employment response that we saw in the first chart. And if you noticed in that chart, some counties had declines of up to 40%, and those are really the tourism-dependent economies of Nevada and Hawaii that have huge shares of employment in these industries. Okay, so focusing in now on the effects of NPIs, we estimate that the NPIs reduced daily COVID-19 deaths by about 500 per day in April and May. And that's relative to actual deaths of between 1,000 and 2,500 over that period. At the same time, again, NPIs lowered employment by close to 3 million. So before we talk more about those numbers, going to jump back really quick to the contact rate. And just note here that, again, on the left, you see a reminder of this. The contact rate explains really only just a sliver of the decline relative to March. And on the right here, we disaggregate that sliver into the impact of the 3 NPIs. So a couple of things to note here. The first is that the earliest NPI-induced declines were driven by school closures, which typically came about a week before the other two. And then overall, about half of the total decline over this period is attributable to stay-at-home orders.
Alex, you have about a minute left.
All right, thank you. Okay, so if we take that, run it through our model, and translate it into an effect on deaths, we see a couple of big differences. First off, the effect is much larger, and school closures play a much larger role in here. And what's going on here, the difference is, really highlights the critical role of timing in epidemiological dynamics. So the early declines in the contact rates are accounting for most of the effect that we see, and because school closures came early, they are accounting for a larger share of deaths than of the contact rate. Turning to employment, again, about 3 million jobs, and here we see again a very different distribution. About half of the decline in employment is attributable to non-essential business closures. This is much larger than their share of the contact rate. So drawing on the implications of that discussion, we're going to consider some alternative approaches that might have led to better outcomes. And the key takeaway from our discussion earlier is that early action is critical. So cutting contacts early in the pandemic has enormous payoffs. And then the second takeaway is that, maybe not surprisingly, business closures have high employment costs relative to the other ones compared with their epidemiological benefits. And this just highlights that difference. But I will not stop there since I'm short on time. So I'm going to consider 2 types of counterfactuals very quickly. First, we ask what would have happened if on March 13th, the day that the president issued an emergency declaration, he had also issued a nationwide stay-at-home order and a nationwide school closure. We find that in that scenario, deaths would have been lower by more than 4,000 at the end of May, and employment would have been higher by about 1 million. So, better epidemiological outcomes and significantly better economic outcomes just by acting early and focusing on stay-at-home orders and school closures. And finally, we consider a more targeted response where counties impose these 2 policies depending on their local circumstances, basically an aggressive response to the number of cases per capita. And we find here, you get somewhat smaller epidemiological benefits, somewhat larger economic benefits, but sort of the small difference between the national and local response, what that highlights is that we often don't actually know what the true case count is because we are not detecting many of the cases. So, the takeaway from this is that it is better to act broadly and early, even if you're not sure, even if there might be some waste in that. Okay, and more in the appendix. Thank you.
Great, thanks, Alex. The discussant is Alessandra Fogli.
So first of all, let me say thank you so much to Jen and Jim for this great opportunity. It's been a real pleasure to read this paper. And it asks a very important question and is also presenting some very provocative results. So the question thereafter is, how effective are NPIs? And this is such an important question, especially now that we're facing, in Europe, the second wave of infection. So how effective are they in saving lives? What are their costs, for employment? And they're using an impressive data set, microdata, and an integrated approach to separately identify the effect of policies from the endogenous behavioral response of individuals to infection. So how does this integrated approach work? Well, first of all, they are looking at the effect of NPI directly on contacts. on the decline of contacts, measure using cell phones and different other measures. And then they model the effect of contacts on infections and then eventually on death. And first, they estimate the parameters, directly the parameters that affect the policy, affect contacts. And then they also introduce this feedback effect from infections to contacts and identify separately the endogenous response. So given these two estimates, the effect of NPIs on contacts and the effect of infection on contacts separately, they incorporate these into an epi model, and they can actually come up with estimates of the total effects of policies on death and the effect of the endogenous response on death. So they use a different approach to estimate the direct effect of NPIs and separately identify from the fear component. So the main results are that the local policies explain only a small fraction of the decline in contact rates. Most of the effect is actually captured by this precautionary motive. And however, because of these nonlinearities, the NPIs can avoid about 30% of the death during the first 3 months. And business closures, as Alex was just saying, is the least effect of the NPIs. Large costs in terms of employment compared to the deaths that are saved. However, let's put these results, which are provocative, in perspective, in international perspective. I was looking at another couple of papers that were just recently published in Nature that are using a similar approach to identify across Europe the effects of NPIs on death and infection cases. So if we put this paper, the results of this paper in perspective, we see that looking at the ratio between averted cases to actual cases, they find about a 0.3 ratio of saved lives compared to actual death. In these other two papers, the Xiang paper published in Nature and the Flaxman paper also published in Nature recently, we find an order of magnitude different effects. NPI seem to matter much more. If we look at US, Xiang and co-authors find about 13, this ratio is about 13. In Italy, even 16. And in the Flaxman paper, it doesn't look to US, it looks to Europe overall. They find that NPIs have saved 3 million lives with a ratio of 23. So the question is important. I mean, how do NPI, how much do they matter? And why do we find such large differences? So this is a very important question. And what I'm gonna do in this discussion is to think about possible ways in which these estimates can differ. So one possible way, and I'm gonna say this up front, is that in these other papers, they do not implicitly include the individual behavioral response. So that is definitely something that this paper is doing that the other papers are not doing. But let me also, as I discuss, bring up other possible explanations that have not been incorporated and that can be useful to think about. So my discussion will be about the estimation of the fees. There are the parameters that govern the effect of NPIs on contacts. And in particular, I will be thinking about the role of heterogeneity in local responses to NPIs. And then the second part will be about the epi component and how contacts translate into infections. And some heterogeneity in the type of contacts can also play a role there that is not being considered here. So let me first think about how heterogeneity in local responses may matter in this estimation. So this is the equation they estimate where the contact rate depends on some time effects interacted with the county characteristics. And then there is the effects of policies, which in their paper is homogeneous across different localities. And then there is a fear effect, which is the endogenous individual response to the confirmed cases, to the infection level in their place. So what I've done here is to run a Monte Carlo simulation and think about the possibility that the fees in the model are really heterogeneous across different counties. And think about some variation, in coefficients, and instead assume that the precautionary motive, the omega t, is constant over time. So no time varying precautionary motive in the real model, in the true model, but heterogeneous response across counties. So what happens? So in the true model, of course, the precautionary model, the motive, which is the blue component, has no effect because there is no time variation. And a lot of the effect is actually due to the NPIs. However, in the misspecified model, the NPIs have much smaller role, the fear has much smaller role, and a lot of this heterogeneity is captured by the time effects that is interacted with county characteristics. So if location I and J have same policies but different declines in contact rates, the model is trying to fit these differences using the precautionary motive that is interacted with the county characteristics. But this is going to imply an underestimation of the effect of policies that can be actually quantitatively important, depending how much heterogeneity there is underlying. So why can we expect heterogeneity in local responses? And one possibility could be differences across different states and counties in compliances, in enforcements, other policies that can be implemented in one county and not in the other can interact, but also differences in the initial structure of contacts. So this is something that I've been working on, thinking about how the structure of contacts can be different across the different countries or different states. And think about the network structure of contacts, so put some structure on these contacts. And think, for example, about how in a small world war where you have some number of contacts and contacts can differ in terms of how close they are and how random they are, this can be important. So think about, for example, New York and Minnesota, and think about the different level of initial contacts. New York is much more connected. Maybe you start with a situation of 8 active contacts per node. Minnesota, well, you can see around my windows, it's not so connected. So we actually can think about having a much lower, initial number of contacts. So if both locations introduce a stay-at-home order where you only can see 2 people, maybe your close, your nuclear family, then the same policy implies different reduction in contacts right away, just because the initial number of contacts was different. So here I'm just plotting how the contacts are changing because of the same initial policy, is being introduced in 2 places that start with a different contact structure. And so there is a difference in the effect on contacts directly, which would be misspecified in a model where fees is homogeneous, and in particular will be underestimated, and can have important effects when mapped into the number of infections. So same policy can have very different impacts in different locations because they start with a different initial number of contacts and different contact structure. So
Alessandra, you have about 2 minutes.
Yeah. So the last part instead is about how the effect of the EPI model in their model. So the other ways in which heterogeneity can matter is because these contacts are different and they actually transmit infection maybe far away in the network, and maybe they're more random and not repeated. So one thing is to see the same person over and over again, and one thing is to meet one person, but every time different, and maybe far away from your common, normal circle of friends. So this paper assumes that all contacts, the last part is like how contacts map into infection, have the same effect on infections. However, we know that there is a lot of heterogeneity in how much these contacts translate into infection, depending on the type of contact. Whether this is contacts with a small group of close nodes, it will have little impact. Random contacts with faraway nodes will have a very large impact. So, for example, this is important for policies because if you think about business closures, maybe closing some large events can be very important because you are cutting down some long links with a lot of random interaction. So here, for example, I'm mapping how the two policies are reducing only long contacts versus reducing all contacts can have, very different implications in terms of infections. Conclusion, it's a very important paper that challenges the common wisdom about NPIs. The consensus view is that these policies have a large impact. This paper finds a much more limited impact, quantitatively important difference. The contribution, which I think is great, is to allow for this behavioral response that is important. People get scared by the increase in infection and endogenously reduce their contacts. But on the other hand, I just want to suggest that this heterogeneity in local responses and this heterogeneity in the kind of contacts can also be important when thinking about policies. Thank you.
Great. Thanks, Alessandra. So thanks for a really clear presentation and a really constructive discussion. We can take questions in the Q&A, and if any of the attendees have questions, please put your hands up. And so we'll start with the first question from Olivier Blanchard.
This is a really nice paper, and I must say I'm surprised by the conclusion. And I hope you reconcile your findings with the alternative findings that Alessandra mentioned. But this is about the introduction of NPIs. We're now in the removal of NPIs stage, and all governments, national, local, and so on, are playing with various changes in the rules, thinking that they may have a big effect. And so the question is, should we just assume symmetry? And basically NPIs removal is not going to make much difference, only a decrease in the infection rate will, or is there an alternative? Is it asymmetric? And do we know anything yet? I mean, I realize you can't do the econometric work you've done on the exit rather than the entry, but if you have anything to say on that, I would be very happy to hear.
Next question from Ben Friedman.
Thank you. I enjoyed the paper as well, and I was curious about an aspect of identifying the difference between the effect of the NPIs and what you're describing as the behavioral precautionary actions that people would have taken on their own anyway. And I can't figure out whether in your procedure, take the example that I observe that in my community, the schools are closed. I observe that in my community, the non-essential businesses are ordered to remain closed. And because of those NPIs, I therefore on my own choose to act in a way in which I would not otherwise have acted. And I can't figure out whether from your I haven't read the paper, but I can't figure out from your presentation whether my endogenous response to the NPIs is washed into your estimate of the NPI effect, or whether my response, because I'm taking it on my own wicket, so to speak, is considered what you're just calling the precautionary response, in which case there would be an effect of the NPI, namely on my independent behavior, that you're putting in the precautionary category. So my question is, which way does it go? And whichever way it goes, I think it informs how we should respond to your estimate of the size of the NPI effects. Thank you.
Thanks, Ben. I'm going to take a question from Jim Stock.
Thanks. This is, as the authors know, I think this is a terrific paper. I think the question that about the sorting out these endogenous things is really important. I think what my sense is of driving this here is as if random seeding of initial conditions at the county level. And that seems like a fairly reasonable assumption at the level that we're going at, but fleshing that out would be great. It does seem like this cries out for some sort of instrumentation, and that's beyond the scope, but that would be a good thing for the next research. One comment is this not, are these, to what extent are is the NPI itself or the endogenous behavior causing the decline? I think that the papers we had at the last Brookings conference, the Gupta paper and the Rothstein paper, were pretty much on the side that the endogenous response, the people getting nervous, was a big piece of it. And those two Nature papers simply exclude it. I mean, they have actually fairly crude diffs and diffs, and there's no endogenous response. So they just capture that a bunch of stuff happens when you shut down the buildings. And that's very much, subject to what Ben Friedman's critique just now was. So I don't put nearly as much faith in those Nature papers as in some of these much more fine-grained studies that we've seen here.
We have a question from Mervyn King.
Myself. Fine, I think I'm now unmuted. My question is how far information about cross-country differences would help to disentangle the point that Ben Friedman raised, which is, if you take Sweden as the obvious example, where they didn't have as many NPIs, but they certainly seem to have had an endogenous degree of caution on the part of households. And of course, that also feeds through to the underlying economic cost. The second point is that I think Alessandra's point on heterogeneity is of enormous importance. We know that in terms of an epidemic, there are super spreaders, the so-called R value to which politicians attach so much weight varies across individuals, locations, and the idea of just having a single parameter here seems to be potentially very misleading.
All right, thank you. Let's turn it back to the authors and give them a chance to respond to Alessandra's points and the Q&A from the audience. So Ken, Alex, John?
And let me just note that the first paper, the next session, looks at the international evidence.
Right.
Alex, why don't you go first?
Alex, there, go ahead.
So, to the question on symmetry of reopening, we have done a little bit of preliminary work here, and I think a big issue with this is the heterogeneity, the treatment heterogeneity seems to be much harder to, a much bigger deal here. It is a lot harder to match up a given reopening event across different jurisdictions. So I mean, I think on so I guess the short answer is I don't expect there to be, is to the extent that we can estimate it, I don't expect it to be symmetrical. I think that there's just so many differences in both what the actual policy is and how it'll affect things. So to Ben Friedman's question on NPIs, so the effects you're talking about, you see that schools are closed, you change your behavior, we are going to pick that up as a response to NPI. So, an interesting thing about this that sort of speaks to the treatment heterogeneity issue as well is that there's not a ton of enforcement, as we can tell, anywhere in the US. You can almost, even though these policies, we are restricting to policies that were, the language said, this is a mandate, you are required to follow this by the law. We really think of them more as almost informational advisory. This is just a more aggressive form of information that governments were pushing out on people. So yes, I think that's I'll hand it off to anyone else.
Kent or John, do you want to add any comments?
Yeah, I mean, just very big picture and only one quick comment is that obviously we allow for heterogeneity by location. A lot. This is really about the marginal effects, and just want to make that clear. Yes, we're going to be exploring a bit more if we have the data and ability to think about kind of a heterogeneous treatment model in more detail. So I think that's a great comment. And we'll, our prior right now is that it's probably not a huge effect, but that could be wrong. And so we're going to be definitely trying to see if we can explore that in the final draft.
So, yeah, sorry, well, I had one more thing on the general question of the response. So, I think we've now seen a number of studies that are mostly looking at stay-at-home orders only for the US. And in those studies, they generally find estimates that are very close to what we're coming up with, about a 10% immediate impact on whatever measure of contacts you're looking at. It's generally within the same ballpark. So yeah, a number of papers at the previous Brookings, and then also some work by Austin Goolsby and Chad Syverson finding very similar effects, even using big census block group level data. So, at least for the US, I'm much less familiar with the international evidence. I look forward to the next session. But at least for the US, I think the stay-at-home orders, we seem pretty in line with other estimates that I'm familiar with.
Terrific. Thanks very much. So I want to thank Alessandra for her comments and the authors for a terrific paper. We will take a very brief break. We'll be back at 11:35 Eastern Time for the next paper, which, as was mentioned, is on the international aspects of this same set of questions. So we'll see you in 9 minutes. Thanks very much.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.